Good afternoon. Happy Friday. Welcome back to Markets for Millennials for the weekly market analysis from September 26th to September the 30th. We have closed September and we have closed the door on the third quarter of 2022. And obviously, I missed last week. I was traveling and out of town, out of reception. I'm not able to look at charts or be connected at all. So I appreciate your patience and your understanding from missing last week. Obviously, not the best weekend weekly analysis to miss, because obviously last week we had the FOMC meeting where Powell came off hawkish as ever. The market's expecting him to relent a little bit, or I guess expecting the 75 basis point hike to be more dovish, kind of like the previous one, but obviously he was very forceful, and the dot plot specifically, I'm not going to go into all of that, but the dot plot showed that the expectation of the FOMC was that rates were going to be in the kind of in the mid, maybe perhaps upper fours on the federal funds rate, and that it would be there throughout 2023. And so the higher for longer narrative, no cuts in 2023 like the markets had been pricing in, that was obviously a very big deal. The market sold off quite a bit on that, and it's been basically down ever since. I'll look through that in just a minute. Some stuff going on this week. I just want to make a point to acknowledge, I saw this on Twitter recently, this specific tweet up here. A person posted emergency Fed meeting announced for Monday. They posted the screenshot of this closed board meeting that is taking place on Monday. And there's a lot being made about that, but I just want to mention, I think I might have actually, I should have it up, but I don't. Oh, here we go. I replied and talked about this. I'm pulling this up because it's not the first time, and it's not even the first time, in the last month. There have been two in September of these kind of closed door meetings. And so it's nothing to go crazy about. It's nothing to make a big fuss about. Obviously, one of these is the FOMC, the normal FOMC meeting, but closed board meeting in earlier September. So these are not abnormal. And so I would just say that this is a big, nothing burger. And I don't think that, I think a lot of people were looking at this or sharing this because they were thinking, oh, is the Fed going to, pause? Is the Fed going to change direction? Because obviously, if we pull up the Great Britain pound, British pound, and the U.S. dollar, obviously the big news was that this week on Sunday evening, going into Monday's open, you had the after a massive sell-off last week, a week ago, you had a huge move. If I pull up the 1 hour chart, this will look even crazier. But you can kind of see just in that first hour, we had a huge move down in the British pound. And it was actually at that particular point, I don't have the tweet up, but on Sunday, I tweeted last week, right before I went out of town, I tweeted that if you have US dollar pairs, because I knew I was going to be out of town and not able to comment much or provide any analysis, I had made the comment that if you have any US dollar, British pound trades, or possibly even euro trades, that you should consider trimming them or closing them, because this type of price behavior is not sustainable. Even just this candle from Friday, this 3.5% candle was just crazy, and that kind of price action is not sustainable. And I was looking also from the perspective of the strength and momentum signal that I have, and you can see the green X's indicate an oversold condition. And what was crazy is that we were oversold on this even before we made this waterfall down. And when we crashed through the volatility range, which is these outer bands, as soon as we crashed down below, I was like, this is not sustainable. And I actually, on Sunday overnight, I closed my US dollar, my pound US dollar trade. And as you can see, that was a good move because price has come up ever since. And if you look at the euro, you also, that same kind of price actions taking place. So once again, Going into Monday, I sold kind of near the waterfall. And it didn't look like that was as good of a trade the next day or so. But then obviously the euro has come up since then. But same kind of situation. You see that green X at the top of the screen right here, showing a massively oversold condition, breaking the volatility range. And so it was due for a bounce, even though it was in the bearish strength and momentum signal. That was still something I noticed. And just in fact, across all of the FX pairs, if you go to the US dollar, Japanese yen, we had gotten a couple of those a few weeks ago. And so the yen, I wasn't ready to get out of the yen because you didn't see any of that crazy price action. You did have a pretty strong green candle, but it didn't touch the upper boundary of the volatility range. But if you look at the US dollar, Canadian dollar, you got the same kind of signals taking place. And like even today, we got another oversold indicator. But again, not like here we touched the upper boundary of the range. We haven't here. As you can see, the volatility range is widening considerably, but I would still expect this to come off. And then if you look at the, I believe it's the US dollar Swiss franc. No, it's not. It must be the Swedish krona. So I believe that's SEK. You got the oversold or the overbought indicator there too, going into the weekend. And so obviously when we touched the volatility range, it was pretty clear that it was time to get out of that trade. So I just thought that would be a good thing to point out. And, I've been a dollar bull. If you go back to October, kind of mid to late October, there was some price action. The way that things broke out, I became a dollar bull back here, and I've been taking bullish US dollar trades ever since, and that's obviously been serving me really well. But a lot of people on this price action are looking at this and saying that this is the top. And I just want to remind everybody all of the different places, drawing them on the map, or on the chart, people calling dollar top here and here and here and here and here and here, and now they're calling it here. And you got to be cautious. I tweeted about this earlier this week that you should expect the dollar to come off. And I'm expecting the dollar to settle somewhere down here because we have this ascending wedge. And I do expect price to break down or to come down, at least wicking below this trend line. And then slingshotting back up, or I guess the way I'm seeing it. So what you should do on the dollar is, if we just talk about some risk management here, using the DXY as a proxy for some of your other trades on the US dollar. If you trade FX, then what you do is you wait for price to, I really believe this is going to happen. You wait for price to come below the trend line and then come back up. And then once it comes back up, you're going to have, obviously, if I just use this green candle as an example, you might have a wick coming down like that. And then what you would do is you would take your long trade and stop loss, be watching that level right here. It's coming in just below 111. And then you use that as your level to manage risk off of, because if price comes down further, then you're wrong there. And that gives you the opportunity then to watch the lower area of this ascending wedge, which at that point you're probably looking at somewhere around 107, 108. And another way to look at the DXY is if you pull up the 50-day moving average, simple moving average. This has been a great proxy for where to watch and manage your risk from. And so right now the 50-day moving average is coming in around 108. And so that's a level, obviously, that kind of fits that area right here, 107, 108. You can kind of see here price wicked down or closed down below the 50, but then came right back up. And so that's why I think you give it that range. Again, if we break below and close below this support and get rejected on the way back up, then you watch that 108, 107, 108 level for a new place to gather yourself. If you look at it from the perspective of the strength and momentum signal, we got the really big overbought signal on a week ago, and we've been coming off. None of this is unexpected to me, but I'm still not calling top here. It could very well be the top. Nobody knows. I don't have a crystal ball, but I just thought that would be a great place to start. And then talking about Treasury yields too, which I made a big fuss on Twitter recently. I've been retweeting a lot of my old tweets, where back on August 2nd, as everybody was drawing head and shoulders patterns, something like that, and talking about the head and shoulders pattern being broken and then coming up for the retest, right here on this big green reversal candle, I basically made the call that I thought we would see a higher high, and everybody thought I was crazy, and there wasn't a lot of engagement on that. And then obviously I talked about this a few weeks ago. We have a very clearly defined trend to the upside, and we're still above that trend line. Now, my goals have been met as far as targets. I thought we would get another move above 3.5, between 3.5 and 4, and we did get up to 4. And so I'm totally willing to look for tops in the yields. I'm not actively looking. I'm going to let price show me that, and I'm going to let the macro show me that. But for now, I actually do expect that in the coming week or so that we will break down from this trend line and we'll get some relief. So actually going forward, I'm expecting, and I'll talk about this on the equity markets in just a moment, but I am expecting a relief rally, a bounce of sorts, if you will, as yields will either I'm thinking yields will either come off sideways or they'll come off down and retest the 3 level, and that's where I think we'll collect steam for the next move up. So either sideways along the 350 or down to retest the 3, and that's kind of what I'm looking for. And so I'm obviously not buying. I'm not going to buy bonds on this because the macro to me doesn't suggest anything soon about this being the actual like top, or that this is even the best spot to buy yields. I'm going to wait for more clarity before I try to buy like long bonds or anything like that, at least the ETFs and things like that. As I go into the equity indices, I just want to make a comment about the PCE, which was released today. PCE came in a little bit below July on the year over year. Core PCE came in higher. You can see that here down here at the bottom of the page. I'll just put it in the middle right there. On the month over month basis, we were back up in core PCE 0.6 month over month. And we went from going down between, June and July, to going back up positive on the headline PCE in August. And so if I go to my economic data table here, I've expanded this because I want to keep track of the year over year and the month over month, and then annualized, the 1 month annualized, 2 month annualized, and 3 month annualized. And what I like to look at is the trend. So obviously, on an annualized basis, we're getting lower overall compared to some earlier numbers. Like in June we had 13.2 annualized. On a 2 month, we're actually way down. We've been trending down a bit over time. But then the 3 month, we're back up. The 3 month annualized on headline. And then core is where it's concerning because you're seeing a kind of a leveling right here on the 2 month. You're seeing an acceleration on an annualized basis, and you're seeing an acceleration on a 3 month annualized basis. It's been since February, the February data being released, that since the last time we had a 3 month annualized PCE of over 5. And so that's not looking good on a core level. And that's kind of the same thing that I had talked about a few weeks back in regards to, or with regard to core CPI continuing to either like level or accelerate to the upside. And that's not a good sign if you are hoping for a Fed pivot anytime soon. So, I mean, this is our highest core PCE year over year number since April of this year. So So that's kind of a big deal. And so obviously, I don't know if that's the reason why. I know that today we also had the third revision for the GDP today, as well as people watching the predictions for Q3 GDP coming in as well. But as you can see, what was it? It was, so 2 days ago was the 28th. That means Wednesday the 21st. That would be this candle that I'm looking at right here. This was Fed day. We were up strong, and then we came off. It was a pretty incredible sell-off, but then we came right back up, and then we sold off again. It was very hectic in price action for a few hours, and then we ended up selling off really big. And we really haven't looked back ever since then, except for a day on Wednesday this week where we had on the S&P it was on nearly a 2% candle. And the big news on price action is that we've made new, not just closing lows. We made a new closing low on, let's see, what is that? That's Tuesday, and then again yesterday and today. But even breaking below the lows of the wicks from June, which is something I've been expecting for some time. Obviously, I was early thinking that I originally thought we would break the lows, around here. I thought price would waterfall down there, but obviously we are a little over a month and a half later before that actually took place. But nonetheless, here we are. On the NASDAQ, it's the same thing. Price finally breaking to a new closing low and breaking below the wick on today's price action. The Dow was the first. The Dow actually closed last week, making a new closing low, and also wicked below the previous the lows from June. And the Dow has definitely been accelerating to the downside. The Russell is the only one that hasn't confirmed new lower lows. We did wick on Wednesday below the closing low from June, but obviously we have not made a closing low below that, and we haven't made a lower wick either. And so I am, like I said, expecting a bounce. I think now that we've broken to new lows, this is a natural place, especially given what I'm seeing on social media for sentiment. I believe that this is an opportune time to see a bounce. I could be a little bit early. I actually did think that we would bounce starting this week, and it took 2 days before we got a solid green candle, and then we obviously sold off hard yesterday. It's actually really crazy looking on the NASDAQ, just this candle from Thursday's price action. But in any case, I think this is a natural place for a bounce to take place. And I think that the fear in the markets is driving a lot of skew and a lot of, I guess, positioning for the S&P to come down. And I've seen different macro data providers out there calling potentially for that the recipe is ripe for gamma squeeze in the markets, and so that's something that I actually am expecting, just given how apocalyptic price action and sentiment is right now. Because, for example, it kind of feels familiar to me from the standpoint of going back to after we sold off in the beginning of June, after getting some poor CPI prints. We came off and we proved in the CPI report for May that inflation had not peaked back in April like everybody had been predicting. So we came down and sentiment was just awful down here. And then we actually bounced from there. And that's, this price action right here, everybody was calling like the most hated rally because it didn't make sense. And so I'm not expecting the rally to be that crazy. I think I'm actually looking for a bounce up to maybe between 38 and 3,900, so something like that before we come down. But I'm not 100% certain about that. But that is something I'm going to be watching for. Be very careful not to chase the momentum to the downside, especially when it comes to shorting. Shorting is the most risky. Because price can come up and then never look back. And I know that we expect price to continue to make lower lows, but it's not a guarantee. On the NASDAQ, I just want to point out that today I moved the trend line because we made a lower low. So if you recall, originally the trend line was like this, and then we broke above it on the bounce into August, and then I deleted it, and I've been kind of just waiting to see what would happen, and then I drew kind of a lighter trend line for more near-term resistance and trend. But now that we've made a new lower low, price action rules dictate that you move the outer trend line, so that the upper resistance, the outer resistance, that you move it to the top of the bounce in August, and this becomes the new line in the sand. And the same thing we would have done if you go back even into the this. So like this is the, I should go to the dot-com bubble. Let's just do that. If we go to the dot-com bubble, kind of a similar kind of situation. When you walk through this, you would you start with one trend line. This is going to be a little light, so I apologize. Right, and then you bounce, and then when you make a lower low, you move the trend line out to the outermost wick. Right, it bounces, and then over here you make a new lower low. So then you find the top of the bounce, and you make a new wick there, and then that becomes the line in the sand. And obviously that was pretty good on the NASDAQ back in the dot-com bubble. It doesn't always look that clean. That one was pretty easy. In this case, we've had to redraw trend lines quite a bit. We kind of started here with that, and then with that, and then with that. Oops, sorry. With that, and now we are redrawing it again. So I'm just sharing with you that's the rule. I did the same thing on the Dow once we made the lower low here. And I will do the same on the Russell if we do close below and make a lower low to the downside. And if that's the case, then the trend line will be out here, if that makes sense. But I am expecting a bounce. And then what's really interesting, I'm skipping to Bitcoin for a second because this is getting really interesting. Bitcoin still, it did make a new closing low. We had one on September 6th. We had another one on September 21st. I would have, or I talked about that. Actually, I don't think I talked about that. I don't think it had happened yet the last time I did a weekly update. But we have not made a new wick low. That still goes back to the June lows. And this is just getting really interesting because we're coming to a point where we have to prove, I'm going to put this trend line right there, where we have to basically decide one way or another. So far, price has been rejected once and then basically a second time here on the trend line. And I've been saying for almost a month now that we're getting to a point where this trend line is getting interesting. So typically the breakage of this trend line would be the beginning of the next bull market, unless obviously we make a lower low. So if we did break above and then we still made a lower low, then we would do the same thing that I just showed you on the NASDAQ as far as redrawing the outer trend line. And that would obviously not be good news to do that. But I do think that part of the reason I think we're getting into a bounce is because so many people are getting so bearish that I think that that max pain would be doing something like breaking this trend line to the upside and getting some bounce here. Because then breaking this trend line will make a lot of people think that we are in a new bull market. And then the worst thing that could happen then is people start positioning in if they're not already, and then price still comes back down and makes new lower lows. So that's why you got to be really careful and have rules for yourself about where you're going to make an entry if in fact you do. Gold, we touched, it's really interesting. We touched exactly here 614. Which is where if you actually go back on my channel, back when I was talking about, well, let me put up the weekly chart. This will make it a little bit easier to see. So I was calling out a potential like long-term cup and handle, and so I was expecting, if I turn this back on now, I was expecting price to come all the way down into this range between 1675 and 1600-ish. and I actually do have a support line at 1547. So I thought I actually do think the lowest place that price could go. Originally, I was saying potentially down as low as 1547, but then obviously we came back up and we had the disorder from the Russia-Ukraine war, which caused price to come back up. But I had been expecting price to come down here for a long time. So we'll just say it this way. I'm not surprised price came down this low. Gold has been at a pretty clearly defined downtrend. And it looks like we caught support on 614 and are bouncing. Is this a reversal candle today? I'm not sure. We'll see. But so far, gold is not responding well to the macro situation. I would expect price to hold on this support, which gold may kind of come up right underneath and then get bounced right as the confluence of the horizontal level and the trend line resistance comes to confluence right there. So I'm not expecting gold to do well. I think that this is kind of a relief bounce here from a pretty oversold position, but not extremely oversold. We still have a red triangle down, which is indicating downside volatility pressure, and so you just want to be aware of that. And then finally, the crude oil, which has been in a pretty awful downtrend, continuing to just make lower lows. Every time you get a couple of days of bullish price action, it just gets sold off really quickly. I'm starting to, as I look at this, I'm starting to wonder if we're getting a wedge pattern here, something like that. I've tried to draw this a handful of times on this chart, so I'm not saying it is a wedge. But as I look just with the naked eye, if I just get rid of this trend line, and maybe I'll get rid of that trend line for a second, it really does, in the same way that you start to get kind of that's really bad, sorry. In the same way that you kind of get a wedge like this, I kind of am seeing the same thing just with the naked eye right here. You're seeing obviously that clear trend line there, and then you're seeing it kind of squeeze right there. So I'm not saying that it's going to do that. I've been wrong about oil. I was, if we just recap a minute, I was back here, I was saying that I thought oil would take a while to make this U shape, this kind of cup shape, before making new highs. And then it did it in half the time that I thought it was going to take. And then as it came off, I was expecting price to bottom right there and then take back off. But obviously it didn't. It just broke through and has continued to come down. I think that will reverse at some point. It may not be until November or December, though, or possibly even into Q1 2023. So I'm not holding my breath for it. I'm just going to watch the macro and pay attention to what's going on and try to pick some technical levels, probably potentially around, we might have even bounced off of it, kind of around our high from July 2021, or possibly the level around 65, which is where you can kind of see we had a top right there, and then support, and then support. So that's where I'm going to be watching on the levels I'm going to be watching on oil. And then I think that's it for today. Again, thank you for tuning in, and I apologize for missing last week. I hope you guys stay safe this weekend and enjoy time with family or friends and do something fun. And the markets will be here on Monday, and I'll be here next week, and so we'll see you then.